Investment trusts, as well as funds, have several characteristics, the most prominent of which is that they allow investors to pool their money with that of others, allowing them to get access to a diverse wide range of assets throughout a single vehicle. It's possible to claim that the resemblance ends there. So, to have a better understanding of things, we must first comprehend the distinctions between investment funds and trusts and then compare them side by side. The main difference between the investment fund and trust is that investment funds are typically established to generate revenue for the fund's managers along with the fund's shareholders and depositors, whilst trusts are established for myriad of purposes, the most prevalent of which is to maintain the property in favor of the beneficiary, with the benefactor having a right to claim the assets once the trust documents criteria are met. An investment fund is a pool of money from an investment group that has pooled together capital to buy assets while each individual retains possession and management of his or her assets. An investment fund offers a bigger range of investment options, more management experience, and cheaper investment costs than a stockholder might get on their own. A financial organization that combines the funds of its own investors and distributes them in a diverse portfolio of securities is known as an investment trust, sometimes known as a closed-end trust. It varies from a mutual fund or unit trust in that it offers units that reflect diverse assets rather than stock in the firm. The price of asset management company shares is determined by the value of the underlying securities as well as the desire for and availability of investment trust shares. An investment fund pools money from a huge handful of discrete investors and invests it in lucrative ventures. Participants in mutual funds have access to a broader range of assets and alternative investments than would be accessible to a shareholder. Because investment funds are actively managed, there is a larger likelihood that the investment firm will be able to meet its investment objectives. The fund issues shares, each of which reflects percentage ownership in the commodities held by the fund. Funds are good for investors who don't have a huge amount of money to invest but yet want a well-diversified portfolio, low transaction fees, and a lot of flexibility. Individual investors don't make judgments about how a fund's assets should be invested when they invest in investment funds. They simply opt for investment funds like fees and other considerations. The price of asset management company and investment trust shares is determined by the price of a particular commodity or asset as well as the demand for and availability of investment trust shares. Management has unrestricted flexibility over the portfolio in most contemporary investment trusts, according to standard charter limitations, since they issue a predetermined number of non-redeemable shares for investment. Investment trusts are referred to as closed-ended funds. In a similar fashion to a regular firm share, investors purchase and sell shares by trading amongst themselves on a recognized stock market. An investment fund gathers money from a huge handful of discrete firms that invest pooled funds in profitable investments, whereas a trust is a contract between two parties in which one party's investments are transmitted to some other party. An investment fund gathers money from a huge handful of discrete firms that invest pooled relates to financial investment opportunities, whereas a trust is a contract between two parties in which one party's securities are transmitted to some other party. Open-ended investment funds are prohibited from borrowing, whereas investment trusts are authorized to borrow funds to invest besides the allocated cash. Investment funds are open-ended funds whereas trust is a closed-ended fund. In the case of investment funds, it is managed by the fund manager solely, whereas trust funds are governed by a board of directors. To summarize, both bring benefits and cons in terms of unpredictability, convenience, and trading costs. Whatever option is best for you, it's critical to monitor progress frequently and ensure that your portfolio is balanced and consistent with your personal financial objectives. Some investment trusts are nearly as inexpensive as index funds. Larger trusts might be a highly cost-effective choice. Investing trusts, on the other hand, are typically considered stocks, and as a result, most investment platforms will levy a fee. We are going to end this video right away. If you have any query or information to share, please leave a comment below. Thanks for watching.